Today we're diving into the world of emerging markets with a popular ETF called SPEM. This bad boy tracks a basket of companies in exciting economies like China, India, and Brazil, but is it the right fit for you? We'll crack open the SPEM mystery, unpacking its diversification, expense ratio, and even compare it to picking individual stocks within the ETF. But before we jump in, is actively managing these emerging market picks the key to unlocking hidden riches, or is the good old SPEM the secret weapon? Stick around to find out. Let's chat ETFs. What is SPEM ETF? SPEM ETF, which stands for SPDR Portfolio Emerging Markets ETF, is an exchange-traded fund, ETF, designed to provide broad exposure to stocks of companies in emerging markets. Here's a breakdown of what SPEM offers and how it functions. Investment objective. SPEM aims to mirror the performance of the SP Emerging BMI Index. This index tracks a wide range of publicly traded companies domiciled in emerging markets, excluding South Korea, which the index considers developed. Investment strategy. SPEM employs a passive management strategy. This means the fund doesn't actively pick or choose individual stocks. Instead, it holds all, or a representative sample, of the companies within the SP Emerging BMI Index, with each company's weighting in the ETF reflecting its weighting in the index, typically based on market capitalization. Benefits of SPEM ETF. Diversification. SPEM offers investors a chance to diversify their portfolio by gaining exposure to a basket of emerging market stocks in a single investment. This can help reduce portfolio risk associated with specific companies or sectors within developed markets. Low cost. Compared to actively managed emerging market funds, SPEM typically has a lower expense ratio. This translates to potentially higher returns for investors as there are fewer fees eating into the fund's performance. Liquidity. SPEM trades on a major stock exchange, NYSE Arca, offering investors easy entry and exit opportunities. What is the investment objective of the SPEM ETF? The investment objective of the SPEM ETF, SPDR Portfolio Emerging Markets ETF, is to track the total return performance, before fees and expenses, of the SP Emerging BMI Index. Let's break this down further. Total return. This refers to the combined return from an investment, including both capital appreciation, increase in share price, and any dividends or income distributions received by the fund. Before fees and expenses. It's important to note that the SPEM ETF's objective is to mirror the index performance before accounting for its own management fees and operating expenses. These fees will ultimately reduce the returns delivered to investors compared to the raw index performance. SP Emerging BMI Index. This is the benchmark index that the SPEM ETF tracks. It's a market capitalization weighted index, meaning the weight of each company within the index reflects its total market value, stock price multiplied by outstanding shares. The SP Emerging BMI Index specifically focuses on companies domiciled in emerging markets, excluding South Korea, which the index considers developed. In simpler terms, the SPEM ETF aims to deliver investment results that closely match the overall performance of the emerging market stocks included in the SP Emerging BMI Index. By achieving this objective, the ETF offers investors a way to gain broad exposure to emerging markets without the need to pick individual stocks. Here's a deeper dive into why tracking an index like the SP Emerging BMI Index aligns with SPEM's investment objective. Diversification. The index holds a wide range of companies across various sectors and industries within emerging markets. This diversification helps to spread investment risk and reduces the impact of a single company's performance on the overall fund. Market representation. The market capitalization weighting ensures the fund reflects the relative size and importance of different companies within the emerging market universe. This allows investors to participate in the growth potential of these markets. Passive management. By tracking an index, SPEM employs a passive management strategy. This means the fund manager doesn't actively try to outperform the market by selecting individual stocks. Instead, the focus is on efficiently replicating the index composition and its performance. How does the expense ratio of the SPEM ETF compare to similar ETFs? The SPEM ETF, SPDR Portfolio Emerging Markets ETF, boasts a competitive expense ratio compared to similar ETFs targeting emerging markets. Here's a detailed analysis. SPEM expense ratio. SPEM carries an expense ratio around 0.07%. As of April 30, 2024, actual expense ratio may vary. This means that for every $10,000 invested in SPEM annually, the fund would charge roughly $7 in fees. Expense ratio comparison. Many traditional actively managed emerging market mutual funds can have expense ratios ranging from 1% to 2% or even higher. These higher fees can significantly eat into an investor's returns over time. When compared to other passively managed ETFs targeting emerging markets, SPEM falls within the low-cost category. Here are some popular alternatives and their expense ratios, as of April 30, 2024. iShares Core MSCI Emerging Markets ETF, IEMG 0.14%. Vanguard FTSE Emerging Markets ETF, VWO 0.11%. Schwab Emerging Markets Equity ETF, SCHE 0.10%. Why expense ratio matters? The expense ratio represents a critical cost factor for investors. Lower expense ratios translate to potentially higher returns because the fund retains a larger portion of its earnings. In the case of SPEM, its relatively low expense ratio makes it an attractive option for cost-conscious investors seeking exposure to emerging markets. While not the absolute lowest expense ratio among similar ETFs, the difference is minimal. How does the SPEM ETF handle dividend distributions? The SPEM ETF, SPDR Portfolio Emerging Markets ETF, likely distributes dividends on a quarterly basis, though the specific frequency may vary depending on the underlying holdings and the ETF's distribution policy. Here's a breakdown of how SPEM likely handles dividend distributions. Underlying holdings and dividends. SPEM tracks the SP Emerging BMI Index, which comprises companies from various emerging markets. These companies may or may not pay dividends. The frequency and amount of dividends received by SPEM will depend on the individual dividend policies of each holding within the index. SPEM's distribution policy. While the exact details can be found in the ETF's prospectus, SPEM likely adopts a passive distribution policy. This means the ETF distributes the dividends it receives from its underlying holdings on a periodic basis, typically quarterly. The exact amount distributed will reflect the total dividends collected from the holdings, minus any fees incurred by the ETF. Impact on investors. Investors holding SPEM ETF shares have two options when it comes to dividend distributions. Reinvest dividends. Investors can choose to automatically reinvest the distributed dividends back into additional shares of SPEM. This process allows for compounding returns over time as any dividends received are used to purchase more shares, which then generate further dividends. Cash dividends. Investors can elect to receive the dividends in cash. This provides them with immediate access to the funds, which can be used for other investment purposes or living expenses. What is the turnover rate of the SPEM ETF? The SPEM ETF, SPDR Portfolio Emerging Markets ETF, boasts a relatively low turnover rate, typically around 6%. Let's delve deeper into what turnover rate signifies and how SPEM's low rate benefits investors. Turnover rate explained. The turnover rate of an ETF measures the frequency at which the underlying holdings are bought and sold within a specific period, typically expressed as a yearly percentage. A high turnover rate indicates that the fund manager is actively trading the holdings, which can lead to higher transaction costs and potentially lower returns for investors due to trading expenses. Each buy and sell transaction incurs commissions and fees, which eat into the fund's overall returns. Capital gains taxes. Frequent selling of appreciated holdings can trigger capital gains taxes, further reducing the returns available to investors. SPEM's low turnover advantage. SPEM's 6% turnover rate suggests that the fund manager trades the holdings infrequently. This aligns with its passive management strategy of tracking the SP Emerging BMI Index. The low turnover translates to several benefits for investors. Lower costs. By minimizing trading activity, SPEM keeps transaction costs down, ultimately preserving a larger portion of the returns generated by the underlying holdings. Tax efficiency. Less frequent trading reduces the likelihood of realizing capital gains and incurring capital gains taxes. This allows investors to benefit from potential long-term growth within the ETF. Reduced tracking error. A lower turnover rate generally helps SPEM stay closer to the performance of the SP Emerging BMI Index it tracks, minimizing tracking error, the difference between the ETF's return and the index return. Comparison to actively managed funds. Actively managed emerging market mutual funds often exhibit significantly higher turnover rates, sometimes exceeding 100% annually. This can drastically increase costs and potentially hinder returns for investors. Turnover rate and investment strategy. The ideal turnover rate depends on the investment strategy. For passively managed ETFs like SPEM, a low turnover rate is desirable as it aligns with the goal of mirroring the index performance. However, some actively managed funds might strategically employ a higher turnover rate to capitalize on market inefficiencies or achieve specific investment objectives. What are the primary risks associated with investing in the SPEM ETF? While SPEM ETF offers exposure to emerging markets, it comes with inherent risks that investors should carefully consider before investing. Here's a breakdown of the primary risks associated with SPEM. Emerging market risks. Political instability. Emerging markets can be more susceptible to political unrest, corruption, and changes in government policies. These factors can create uncertainty and volatility in the stock markets, impacting SPEM's performance. Currency fluctuations. The currencies of emerging markets often experience greater fluctuations than developed market currencies. This currency risk can erode the value of SPEM's holdings if the local currencies weaken against the investor's home currency. Less developed regulatory environments. Emerging markets may have less stringent regulations and corporate governance practices compared to developed markets. This can increase the risk of fraud, accounting irregularities, and poor management within companies held by SPEM. Lower liquidity. Emerging market stocks can be less liquid than developed market stocks. This means it might be harder to buy or sell SPEM shares quickly at a fair price, especially during periods of market turmoil. Market risks. Volatility. Emerging markets are generally considered more volatile than developed markets. This translates to potentially larger swings in SPEM's price, both upwards and downwards. Investors with a lower risk tolerance might find these fluctuations challenging. Economic slowdown. A global economic slowdown can disproportionately impact emerging markets, leading to decreased corporate earnings and potentially negative returns for SPEM. Passive management risk. Tracking error. While SPEM aims to track the SP Emerging BMI Index, there will always be a slight difference in performance between the ETF and the index. This tracking error can arise from factors like fees, dividends withheld by underlying holdings, and the inability to perfectly replicate the index composition. Other considerations. Concentration risk. Depending on the specific holdings of the SP Emerging BMI index at a given time, SPEM might have some concentration risk. This means the ETF's performance could be heavily influenced by the performance of a particular sector or a few large companies within the emerging markets. Geographic focus. It's important to note that SPEM excludes South Korea from its holdings, which the index considers developed. This means investors won't gain exposure to this potentially significant emerging market. How does the volatility of the SPEM ETF compare to the broader market? The SPEM ETF, SPDR Portfolio Emerging Markets ETF, generally exhibits higher volatility compared to the broader market, which typically refers to a benchmark index representing developed markets like the SP 500. Here's a detailed analysis of this volatility difference. Sources of higher volatility in SPEM. Emerging market risks. As discussed previously, emerging markets are inherently riskier than developed markets due to factors like political instability, currency fluctuations, and less developed regulatory environments. These factors can lead to larger price swings in the stocks held by SPEM, translating to higher volatility for the ETF itself. Economic sensitivity. Emerging economies are often more reliant on commodity exports and are more sensitive to global economic cycles. A slowdown in developed economies can have a more pronounced impact on emerging markets, leading to greater volatility in SPEM's price. Volatility measurement. To quantify the volatility difference, we can compare the standard deviation of SPEM's returns to the standard deviation of the broader market index, e.g., SP 500. Standard deviation measures the historical dispersion of returns around the average return. A higher standard deviation indicates greater volatility. Historical performance. Historically, emerging market indices like the SP Emerging BMI Index, which SPEM tracks, have exhibited higher volatility than developed market indices like the SP 500. This translates to potentially higher returns during bull markets, but also deeper losses during bear markets for SPEM compared to the broader market. Risk-return trade-off. The higher volatility of SPEM comes with a potential for higher returns. Emerging markets can offer significant growth opportunities due to their faster economic expansion and potential for corporate earnings growth. However, investors must be comfortable with the increased volatility to potentially benefit from these long-term rewards. Volatility and investment horizon. The impact of volatility can be mitigated by a longer investment horizon. Over extended periods, market fluctuations tend to even out, and investors holding SPEM for the long term are more likely to capture the potential growth of emerging markets despite the volatility. Volatility management strategies. Investors seeking to manage the volatility of SPEM within their portfolio can consider diversification. Combining SPEM with less volatile assets like developed market ETFs or bonds can help create a more balanced portfolio with a reduced overall volatility. Dollar cost averaging. Investing a fixed amount of money into SPEM at regular intervals throughout market cycles can help average out the cost per share and reduce the impact of volatility on the overall investment. How does the SPEM ETF perform in different market conditions? The SPEM ETF, SPDR Portfolio Emerging Markets ETF, can exhibit varying performance depending on the prevailing market conditions. Here's a breakdown of how SPEM might react to different market environments. Bull markets. Potential for outperformance. During periods of economic expansion and rising stock prices, emerging markets can outperform developed markets due to their faster economic growth and potential for higher corporate earnings. This can translate to significant gains for SPEM as the value of its underlying holdings increases. Increased liquidity. Bull markets typically bring greater liquidity to emerging markets. This can benefit SPEM by making it easier for investors to buy and sell shares at fair prices. Bear markets. Higher vulnerability. Emerging markets tend to be more vulnerable to economic downturns compared to developed markets. This can lead to deeper losses for SPEM as investor sentiment sours and company earnings decline. Currency depreciation. During bear markets, the currencies of emerging markets might weaken against stronger developed market currencies. This currency depreciation can further erode the value of SPEM's holdings. Factors influencing performance. Global economic conditions. The overall health of the global economy significantly impacts emerging markets. A strong global economy can fuel growth in emerging economies, benefiting SPEM. Conversely, a weak global economy can trigger financial crises and recessions in emerging markets, leading to losses for SPEM. Commodity prices. Many emerging economies are reliant on commodity exports. Fluctuations in commodity prices can impact their performance. Rising commodity prices can benefit SPEM if the ETF holds companies within these sectors. Conversely, falling commodity prices can hurt SPEM's performance. Investor sentiment. Investor risk appetite plays a role. During periods of risk aversion, investors might pull money out of emerging markets, leading to price declines in SPEM. Conversely, increased risk appetite can drive capital inflows to emerging markets, boosting SPEM's price. What is the correlation of the SPEM ETF to other asset classes? The SPEM ETF, SPDR Portfolio Emerging Markets ETF, generally exhibits a moderate correlation with other major asset classes, but the specific degree of correlation can vary depending on the asset class and the specific time period under consideration. Here's a breakdown of what correlation means and how SPEM interacts with other investments. Understanding correlation. Correlation measures the degree to which two investments move in relation to each other. A correlation coefficient between -1 and +1 is used. Positive correlation, +1, the investments move in the same direction. When one goes up, the other tends to go up as well, and vice versa. Negative correlation, -1, the investments move in opposite directions. When one goes up, the other tends to go down, and vice versa. Zero correlation, 0, the movements of the investments are independent of each other. SPEM's correlation with different asset classes. Developed market stocks, e.g., SP 500 SPEM typically exhibits a moderate positive correlation with developed market stocks. This means they tend to move in the same direction, but not perfectly. During economic expansions, both SPEM and developed market stocks might rise. However, emerging markets can outperform developed markets due to their faster growth potential. Conversely, during bear markets, both might decline, but SPEM might experience sharper losses. Bonds, especially high-quality government bonds, are generally considered less volatile than stocks. SPEM typically has a low, or even slightly negative correlation with bonds. This means that when stock prices fall, including SPEM, bond prices might rise as investors seek safer havens. This negative correlation can help to hedge against some of the volatility of SPEM within a portfolio. Commodities, the correlation between SPEM and commodities can vary depending on the specific commodity. Some emerging economies are heavily reliant on commodity exports. Rising commodity prices can benefit SPEM if the ETF holds companies within these sectors. Conversely, falling commodity prices can hurt SPEM's performance. Benefits of diversification. Understanding the correlation between SPEM and other asset classes allows for effective portfolio diversification. By including assets with different correlations, investors can potentially reduce overall portfolio volatility. For example, the negative correlation between SPEM and bonds can help to offset some of the losses experienced by SPEM during market downturns.